For the first time in years, the yields that you can get from your bank are hovering near 5%. That's a safe and easy solution to make money by clicking that buy button. But with the right real estate investment, dividend stocks, or lifestyle businesses, it's possible to earn even higher rates of return without lifting a finger. Passive income is real, but there's a catch. Today, we'll explore 3 stories from real people who are building passive income and break down the details they and you may not be thinking of. When interest rates are rising, that can hurt Daniel's real estate investments in a particular way. What Joel should do, in addition to looking for high dividend paying stocks, is to make sure he can defend those positions if they go against them. Reddit post number 2 says, how I make $12,000 a month on top of my 9-to-5 job. I'm Tom Preston, Chief Market Strategist of tastylive. This is Money Makeover. The first post says, how I turned $5,000 into 6-figure passive income at 25 years old. This is Daniel. Daniel's 25, graduated from college in 2019, quit his job to live off passive income of $116,000 a year from rental properties. That's pretty good work, Daniel. Graduated with a Bachelor of Science in Mechanical Engineering and made about $65,000 a year for his first few years out of college. He says, around 2 months into my new job, I opened a brokerage account and put $5,000 into it. Initially, I was buying shares and would get excited when I made $2. Yeah, Daniel, that sounds like a trader. I read all of your typical R/investing advice. However, even after not a full month, I got bored. That's when I found Wall Street Bets. I saw all the people leveraging their money into options and making crazy 40, 60, 100%, even 200% returns on a single day. He grew $5,000 into $65,000 trading options, then put half of those earnings into GME GameStop shares in December 2020 and made $375,000 in profit after taxes. So Daniel then took that money and reinvested it to own 13 properties. He took out a $1.5 million debt to finance them, and he makes about $300,000 annually from rent pre-tax. Net free cash flow is about $116,000 a year. Daniel, congratulations. Now, Daniel did something very interesting with his portfolio, whether he recognizes it or not. When he moved money out of, let's say, GameStop and into real estate, he realized that those gains he was getting in those meme stocks like GameStop or AMC, where people are getting, 40, 50% returns, those are hard to find. So what Daniel did was very smart. He realized, hey, what's repeatable or more repeatable are rents from real estate. So when interest rates are rising, that can hurt Daniel's real estate investments in a particular way. He already has his mortgage, hopefully at a much lower rate than what he can get now. But what happens is when interest rates go up, it can hurt the business cycle. Companies lay off people, businesses close. That's where people are getting money to pay rents. So if the economy slows down, he might not be getting the same rents that he was getting as when the economy was doing a little bit better. But there are 3 things that I would suggest to Daniel. 2 hedges and 1 thing he can actually do to earn money against his real estate portfolio. The first is if real estate continues to drop in value, he could short some real estate ETFs like VNQ or SCHH. They invest in REITs, and yes, they go up when real estate goes up and down when real estate goes down. Second, he could consider selling some bonds, shorting bonds. When interest rates go up, bonds go down. It's an inverse relationship. So a bearish trade in bonds would also hedge potentially his real estate investments. The third thing that Daniel could do to take advantage of the high rates specifically is to pull some money off of his real estate investments and put it into things like CDs. Not very exciting necessarily, but the rates are the highest they've been in years and the risk is relatively low. And if for some reason his rents start to go down or people stop paying, his CDs could recoup some of those losses. Reddit post number 2 says, how I make $12,000 a month on top of my 9-to-5 job. This is Bryce. He's 28 years old and married. He works in IT by day. He codes side projects and makes content by night. He has a portfolio of businesses, and one is web hosting, and from that he generates about $1,200 a month. Second, he has rental properties that generate about $2,900 a month. Bryce and his wife own 7 residential real estate properties and 9 storage units, beginning to invest in Airbnbs as they've heard of people earning 2 times the return on Airbnb than long-term rentals. And then he gets into the stock portfolio, from which he has $0 a month. Quote, I mentioned in my original post that my wife and I were planning on pulling all of our money in the market to focus more heavily on real estate, and we did just that. Even though people are making a killing in the market right now, and it's incredibly tempting, we're sticking to our guns and only investing in what we know and what's working best for us. So Bryce also has investments in from a YouTube channel, an Etsy shop, some affiliate marketing, selling classes, and software projects. Now, Bryce talks about putting all of his money into real estate and not putting any money into the stock market. Why? Because he's more comfortable with real estate. One of the things maybe that Bryce has to think more about is liquidity. How quickly can he get out of a position? With stocks, I can buy a stock today and sell it tomorrow. It's very liquid. It's easy to enter and exit a stock position. Real estate, not so much. In 2008, for example, when real estate prices were dropping, home prices were dropping in front of people's eyes. I can't sell my house tomorrow, okay? It's going to take at least a few weeks or maybe months or even longer, particularly if prices are dropping and it's a buyer's market and nobody wants my place. That sort of liquidity risk is very real and something that Bryce needs to understand before he puts more money into real estate. If he's thinking about, gee, I don't understand the stock market, there's an easy way to fix that. Start learning about it and diversify your risk. To take some positive steps to diversify his portfolio, Bryce could, of course, put some money in CDs, just like we've been talking about. But one more thing he can do is buy some higher yielding dividend stocks. The stock market's been weak recently, and with lower stock prices, a given dividend payment makes the dividend yield higher. If Bryce is willing to take some more risk, he can capture those higher yields through dividends. That takes us directly into Reddit post number 3. Can I work 20 hours a week and live off passive dividend income? So this is Joel, and Joel is living in Australia and recently came into some money via company shares. He would like to take a part of his new money and put it towards dividend yielding ETFs. He says, I will probably invest in a mix of VAS and VHY. Assuming both of these yield an average of 6% over time, this should produce an income of around 180,000 Australian dollars, which is a generous safety net. So Joel is on the right track of thinking about getting higher returns based on dividends. Nothing wrong with that. But remember that when you buy a stock, whether it's high dividend paying or not, you have risk that the stock price goes down. And the dividend will only protect you so much. If the stock price drops too far, the dividend will barely make a scratch on that loss. What Joel should do, in addition to looking for high dividend paying stocks, is to make sure he can defend those positions if they go against them. One of the ways to do it is to sell calls against that long stock.
Let's go to the next slide and we'll just visualize what a covered call is, and we'll look at some basic calculations here. So we've got our opening trade, and a covered call, if we just remember back, is just buying 100 shares of stock at the current stock price and then selling an out of the money call against that. So
for example, in America, if I bought, let's say, shares of AT&T that has a really high dividend yield, I would know that I can sell calls against those shares if AT&T starts dropping. Don't think that you can just stick your money in the dividend in a high dividend paying stock and let it go on forever. If you are going to pursue building a portfolio in part or in whole with dividend paying stocks, there are 3 things that you might want to consider. First, make sure the stocks are actively traded. Second, make sure the dividends are stable. Look at the dividend history. Do they pay regularly? Do they increase over time? Third thing to think about if you're pursuing high dividend yields is diversification. Even though one industry sector might have stocks in it that have the highest dividend yields, don't put all your money there. Diversify across industry sectors. You can even add ETFs that have high dividend yields as well. The key is that you are diversifying your risk and not betting all of your money in just the highest dividend. Now, for everybody, passive income is real, but keeping passive income takes work. Remember, risk and reward go hand in hand. And if you're really looking to work hard and be active with your money, you may be considering day trading. But before you place your first trade, learn from other people's mistakes by watching our last Money Makeover episode here.